In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome back once again to all of our Market Rebels, and it's that time again for Coach's Corner, and I am joined again by Stu, who everybody knows. Say hi, Stu, and by Scott Thorstensen.
Hello, everyone. Good to be here.
Yeah, thanks for joining us again. And today, this topic came up after having a conversation with two of you about questions that you typically ask your students, your traders, and something that always poses a problem. And so we thought, you know what, let's do that as a Coach's Corner. So here's today's topic, but before we get started, as always, we're going to do a little teaser question in our Chalk Talk section. So if you can, please jot down an answer, and then at the end, we'll show you what the answer is if you haven't figured it out by about halfway through the presentation. So here we go. We've got the stock trading at 103, and the $100 call is trading for 4. And your broker's platform says that the delta is 70 or 0.7. And the question is, what delta is the call moving towards as time passes? Is it going to stay at 70? Is it going to rise? Is it going to rise to 85 and stop? Is it going to go to 0? What number is it moving towards?
Is it going to stay at 70?
Yeah, exactly. Could it just stay there? Which a lot of people think. Now, again, that's our question. We'll come back and visit it. So the question or the topic for today, and I did this just for you, Stu, because I know that you always say whenever you ask this question to students, you get crickets.
Crickets.
So this is the anti-cricket presentation, and we're going to call it What Will the Position Look Like? But this is part 1.
I have to tell people that it's not a trick question. Just
that's right. There is a way to figure it out, and that's what we want to show you is a little bit of a model you can put in your head and figure out where these positions are moving and why. And that's critically important, especially when you start getting into more complex positions. Hard enough with just calls and puts, but you start doing spreads and butterflies, condors, it gets really hard unless you understand this little method. So part 1 today, we're going to talk about, we'll find out there's 3 different factors that are the primary drivers of this. We're going to cover 2 of them today, and then next week, we'll cover the second one. So that's why it's a 2-part. So here we go. The first thing to remember, everybody, most people, come from a stock trading background, and stock is super easy. It's a straight line. There's no curvature to it, no gamma. Straight line, which means its delta is the same. And in fact, it's always 1. So what does delta 1 mean for stock? Well, it means if the stock is 100 and it rises $1, you make $1. All right, no surprise there.
And it doesn't change.
And it never changes. It goes up another $1.
Doesn't matter if the stock is 50 to 250, 500, 5,000. It's always going to be 1.
Or if it goes up $5, you make 5. That's what it means to be a 1-to-1 ratio or a delta of 1. Now, of course, it's going to cut equally well to the downside if the stock falls $1
Yes, it
you're
will.
going to lose $1.
Yes, you will.
But that's why a lot of times stock traders don't talk about deltas, because it's just pretty obvious.
It's a no. How many shares you have? That's it. That's the answer.
Yeah, if you got 500 shares, you got 500 deltas. Every time it moves up $1, you made $500. But that's not true for options, and that's why we typically hear crickets.
Yeah.
So the thing that you have to understand is that this whole trick that we're going to show you, this whole model to put into your head, and it's very simple, by the way, is to understand that it's all about the probability of an option expiring in the money. That's it in a nutshell. The market is really trying to figure out which options will be in the money at expiration and which will be out of the money. All right, so think of that. We've got all of these strikes out here. And as time passes, we're saying, okay, I think these strikes over here are going to be in the money. These I'm not sure of. These are definitely going to be out of the money. They're so far out of the money. Time passes more, we update our information. But we're ultimately trying to sweep them into two halves of the room. In the money, or winners, out of the money, and losers.
I have a quick question for Scott. Is that you in the green hat? Is that you in the green hat, Scott?
Is that me in the green hat?
Yeah.
I don't think I could ride a horse. I don't. I have ridden a horse maybe twice in my life.
So anyway, if you remember, that's really what it's all about, the probability of expiring in the money. Now, in the options market, it's a subjective probability. It's not really a hard probability like, let's say, with a roulette wheel, which we know out to multiple decimal places what we could expect after 500 spins, let's say. That's not true for a horse race, because we can't run a horse race over and over and over and say, how did they turn out? It's not really fair to say that if there's 8 horses, that each one has a 1/8 or a 12.5% chance of winning. But it's still, the crowd will have some sense of, hey, I think I like horse number 3 or horse number 8. And then as the horses start coming around the track, people will start updating their information. So realize that's kind of what we're up against. Even though I'm talking about probabilities, they're not a probability that you can go and look up.
And when Bill says updating their information, what he's really saying, what he's trying to get across here is that the probability of winning or losing or where they're going to come in, that's all changing. It's very dynamic. I think I mentioned last time there, I have students every now and then that tell me that they've been taught that options are very static, that they just are what they are and they don't move. And nothing could be further from the truth. They all have curvature, which is why we love options. Right. And, just because it's whatever it is at this point in time, it will change. And that's what you got to get a handle on. And that's what we're trying to do here.
So the thing is that if you just always remember, it's this idea of expiring in the money. I'm going to keep hammering on that point. It's also important to understand this does not mean the probability of expiring with a profit. So you might have bought the at the money option for 5 and it closes 10 cents in the money. It expired in the money, even though you basically took a 100% loss.
Yeah.
Right. So really just remember, we're just trying to
separate out value from
versus expiring in the money.
Yeah. Nobody cares what you did. That's really hard for people to do sometimes, Bill. I've noticed. Well, it's in the money, but I didn't make any money. Well, it doesn't have anything to do with you.
Got nothing to do with it, right? We're just trying to figure out did the stock price cross this strike or did it fall below? So here's kind of a good analogy. Let's say that this is our horse race. Little question for you here, Stu. Got to think about this one. I like throwing out trick questions. This horse out here in the lead.
Yeah, man.
How much confidence do you have in that horse winning?
You did preface this with this is a trick question, right? I don't have all the information, Bill. I need to know how much time is left.
Okay. I would take that. Or what else could you word it?
I could say,
where's the finish line?
Yeah. I mean, if the finish line is 2 inches in front of the guy in the black hat,
right. It's right here on the edge of the photograph. You're almost 100% certain.
It's a 100 delta. It's a 1 delta. If they're just coming out of the gate, it's
probably close enough to 50 delta. So not enough information to. It's technically in the lead, but nothing to talk about right now. There's still too much. It's not a big enough lead, and there's still too much time.
And that's a great point too, because oftentimes people fail to ask the right question. Like you asked me the question, it really wasn't the right question. You were trying to trip me up in a way, but it wasn't the right question. And that's what you have to catch yourself doing. What's the right question that I'm trying to ask here?
Yeah. Some people look at this and say that I have no confidence in this horse winning because look at how looks like 4 of them that are really close, maybe 5. But that's missing the point. If the finish line is right here, now you do have confidence. It's the same group of horses. And yet in one case, you've got no confidence. In the other, you have total confidence. Mm-hmm. And so, or if the finish line were a little further out, maybe it's not 100%, but you might lean towards this horse. You might say, I'm going to give it 75 or 80% chance.
Yeah, this is a great example. And
that's what the market's trying to do.
Think about how this changes from the horse coming out of the gate through the first turn, the second turn, the third turn. It's just changing and changing.
So if you look here, another shot, similar question. Scotty, how about you? Let's look at this guy back here in dead last. What are your odds here or your confidence level about this horse winning and why?
He looks like the long shot. If you're betting on that horse, that's a low probability to me. I think being that far back, it looks like they're around the first corner. He's got a chance, but I see that horse as out of the money, pretty far out of the money.
Right.
Option.
Now take a look at
low
here.
Probability.
Exactly. Now take a look at what happened here. This horse is so far away from the lead, or in options term, that it's so far away from the stock is so far away from the strike that even though Scotty didn't ask where's the finish line or how much time is left, because it didn't matter, because he's saying it's so far out of the money, I've got virtually no confidence. All right, so that's really, once you understand this little kind of, we'll call it a model to kind of work with in your head, it's always about how much confidence you have with the option expiring in the money. So it's going to be this interplay between where is the stock, how far in the money is it, versus time.
Yeah.
Okay.
And the time part is picture is how far away from the finish line. And, Bill, exactly. You said that this is kind of subjective. It's interesting because Scotty gives it next to nothing or very, very low. Mm-hmm. I might give it a little more than the next to nothing.
And how would you do that in the options market?
What's that?
How would you do that in the options market? Let's say that this is the option, relatively speaking, and the high bid on it is 10 cents. How would you up those odds?
Well, I could up the odds by a couple ways. I could go further out in time and give it a higher delta.
Well, no, but just say for that one right there, you could buy it.
You're saying it's a buyer.
You'd be a buyer. You push the price up, and therefore it pushes the relative values up. It pushes those deltas up. Exactly. So again, it's a really good model to work with. Now, before we get into some examples and some more details, please remember, check us out, marketrebellion.com/get started. All kinds of great information, articles, videos to help you get started in options trading the right way. So for today, there are other drivers, but primarily it's going to be the stock price, time, and volatility that are going to change these relative values, these relative perceptions. And for today, we're just going to be talking about stock price and time. Next week, we will look at just volatility. That's why we call this part 1.
Keep in mind that time moves, stock prices move,
and volatility moves.
Volatility does move. We'll get to that next week. The strike price that you're talking about, that you're identifying, remains constant.
Yeah.
It's the stock price that's moving around the strike price.
Correct. But interesting point. Relatively speaking, think of it like the horse race. If a horse comes from behind in front, did one horse fall behind or one go in front?
I guess that depends on how much money you got on
it. but it's relative. So yes, you could say the stock price moved up above the strike, or we could say the strike price moved down. But it's relative. But I know what you're saying. Once you buy that strike, it does not change. Yeah. But the stock will definitely change.
For sure.
But it's this relative positioning that you want to think about. So remember, there's 3 ways to push an option deeper in the money or deeper out of the money. If you go deeper in the money, you have more confidence about the option expiring in the money, and then vice versa. It's that simple.
So again, for today, it's just going to be moneyness and time. Now, what in the world is moneyness? Well, moneyness is a term that we use in the options market. Don't bother looking it up in the dictionary. I'm sure it will not be there. But it's really a collective term for in the money, at the money, or out of the money. So if I said, hey, Stu, these options here, what's the moneyness on them? You might say, well, 2 of them are out of the money and 3 are in the money. It's just a collective term instead of having to always say in the money, at the money, and out of the money. But that's what we're talking about, are these relative positions. So as the stock price moves, the option becomes more in the money or more out of the money. That's the whole key. That as that moves, this relative positioning is changing. And together, again, together meaning time and how far in or out of the money, they show the probability for the option to expire in the money.
At that moment.
At that moment, very good. Now, that is exactly the rationale behind the Black-Scholes model, is what it's doing. Of course, the probabilities are a lot more complex. But in an active market, it is more like a horse race. It's a subjective guess as to what people think is going to happen. And the way that they change the odds is to either buy or sell the option. So the thing to remember is that it's all about probability. Now, the next thing you have to understand is that delta is roughly, and I do mean roughly, the probability for an option to expire in the money. Now, I know some of the purists out there are going to say, hey, wait a minute, that's not true. And you will read that in a lot of books, that delta is the probability. It's not really true. They're related, and at most of the times it will be a rough approximation. But remember, when we're talking about a model, again, some type of a framework for coming up with an answer, that's not really the important point. It's, does the model give you the right answer? And so if you just think that delta is roughly the probability or your confidence level for the option to expire in the money, then you're home free. So if an option is at the money, what do you suppose the probability is that it's going to expire in the money, or out of the money for that matter?
Half and half.
Half and half. It's like a coin flip. And you'll see, if you put that in a pricing model, it's going to be roughly 50. Yeah. They might say if there's a lot of time, or you put in an interest rate, it might be 52% or a little higher. But roughly speaking, remember, we're not trying to get it exactly accurate to 10 decimal places. We're trying to get a model to say this could be somewhere around a 50 delta. As the option moves in the money, what's happening to your confidence level about that being in the money? Certainly got to be better than 50-50. It's going to increase. So, Stu, if your confidence is increasing, what's happening to the delta? Keeping in mind that delta is the probability, roughly.
Yeah, so it's going higher. And think about it, everyone.
It's an increase.
If it's further in the money, there's more distance that it now has to travel to actually get out of the money.
To get out of the money. Right. Or if your horse is that much further in the lead, it's just that much harder for it to fall out of the lead.
Fall out of the money, or for somebody to catch up.
But as Stu said, in the markets, the strike can't catch up. It can't move. But the stock could certainly fall.
Absolutely.
And we're saying, but yeah, if you get super far in the lead, even if it falls, it's still going to be an in the money option. All right, well, now I know it's going to be a high delta. So as time passes, in the money options have a greater chance of expiring in the money. So Scotty, let's say we have an in the money option. Maybe it's a delta 70 or 80. But now we're going to start shrinking time, getting closer to expiration. What does that do for your confidence about it expiring in the money?
Increases.
It's going to increase. So if it increases, what's happening with your delta?
It's increasing as well.
Because that's
closer, there's less time for it to go out of the money.
There's less time.
Time is passing. It's time's effect on delta is increasing. Your option will be either in the money or out of the money. It will either be 0 or 1.
If you had to guess, as you might have a 70 or 80% chance of expiring in the money. Again, that might be your assessment. But as time starts shrinking, your confidence has to start going up. It's got to go up. So let's look at a different model. Let's go to one that actually has a time clock. Now, a horse race doesn't really have a time clock. It's got a finish line, but there still is a point at which it finishes. I like using pro sports that have a time clock, so things like basketball, football, because we can physically see the time going off the clock. All right, so let's come here. I know this was a Super Bowl a few years ago, so let's say that we're going to say for right now, we're not going to put Tom Brady into the equation. We got Kansas City and the Bucks. The score is 0-0 at the start. And Stu, what do you suppose is the probability in the absence of any other enlightening information about this game? What would you assess this
Going
time?
to be the same, 50-50.
Going to be close to a 50-50 shot.
Yeah, and then be careful, everyone. I'm not putting Mahomes into it. I'm not putting Brady into it. We're just saying both teams are relatively equal, and what's the chance of one winning or one losing over the other team?
And statistically speaking, any given team can beat another on any given day. So, which is why most of the time the point spreads are fairly small. But again, that's not the point we're trying to argue. We're just trying to give it a starting point. All right. And no matter what your starting point is, that's fine. You're still going to see that you'll come up to the right answers. We're just putting this so we can have a number to work with. Now, let's say at the end of the first quarter, Chiefs are ahead 7-0. What happens to your confidence level now, Stu?
It's about the same, Bill.
Is it going to go up or down, though? I mean, it's better than 0-0. It's better than tied.
Well, it's going to go up a little bit.
Okay. I would take that. So that's what I came up with. Maybe 52. Maybe you said 55, 57. That doesn't matter.
Still
We're trying to make sure that we get the direction correct.
Yeah.
Did you push it higher? All right. So we've got less time on the clock and we have a little bit of a lead. So
think of it like we said before, less time for the Bucks to come back.
They got to come back.
Less time for the Chiefs to lose it some way.
Yep. But it's not a huge lead. So that's why we're not pushing this probability up.
Still 3 quarters left.
Still through. It's early in the game.
Yeah,
so let's push it down to the second quarter. Score is still 7-0. What happens now?
Just going up a little more.
Going up a little more. Let's look at the third quarter. Let's say it's 35-7.
95, 98 Delta.
Yeah, it's going. Your confidence is going up. Now, is it possible they could lose?
By the way, everyone, I haven't seen these numbers.
It's just a subjective thing. As long as you realize that you should have gone up from 60. You know, if you made this 70, that's fine. You made this 85, that's fine. Yeah, you're getting the idea. It's about moving in that direction and why.
And for those of you that try and nail it down, like what's the exact answer?
You're not.
It doesn't matter.
It's not going to happen even in the real world. It's not going to happen.
Doesn't mean anything.
What you have to do to be a trader is to say, where are these deltas going?
Where am I going?
And if I can figure where the deltas are going, I can figure out where the gammas are going. I can figure out where the thetas are going. I can figure all of that out. But we got to start with what I think is the easiest by looking at deltas. And that's always about this confidence. So let's go to the fourth quarter. Actually, late in the fourth quarter, let's say we're at the 2-minute warning. We've got 35-20. Now, notice that the spread has narrowed here. That's why I did this.
Yeah.
We used to have a 28-point spread. Now it's a 15-point spread. So therefore, this number should come down, right, Stu?
Negative.
Why?
Because it's only 2 minutes. And it's at this point, it's a 3-score game. I'm going to give it, look, I'm not sure. I would give it 100, but I would certainly give it higher than 95. I might give it a 98 or 99, but it's right in there.
That's the idea.
Even if it is 100, which it doesn't really matter if it is or it isn't, but even if it is, it doesn't mean with a minute left, it's going to be 100, right?
That's
that
right.
Number might change.
It's a subjective probability. Right now, the crowd is saying it's 100% chance.
Yeah.
Right. That's different from a real hard probabilities where we're doing roulette wheels or something. It's just the crowd's assessment. This is where you're going to start seeing people leaving. You'll probably start seeing leaving the stands in the third quarter because in their minds are saying this is basically over. That's your cue to say it must be a fairly high delta. All right. Let's try another one. We start off with 50%. Let's say it's 7-0 at the end of the first quarter, and maybe we give it 55. I think we had 3-0 in the last one at 52. So we go up a little bit more. But now the second quarter, it's 7-0. What happens now, Scotty? Spread's the same.
Probability still goes up. Score hasn't changed. It's a boring game. I'm starting to look for popcorn and a hot dog at this point, but probabilities increase a little bit halfway through the time.
It's still plenty of time for the Bucks to come back. It's not a huge lead. Now, the third quarter, It's still 7-0. What happens now? Same thing. It's going to go up.
Little bit.
Now we go down to the, let's say, the last 5 seconds of the game. And let's say the Chiefs are in possession. What happens to the probability now?
100%.
So the point is, in this case, we kept the spread exactly the same, and yet the deltas changed. Your confidence levels changed. Why? Because the relative distance changed.
Bill,
It's not just that it's 7-0, it's 7-0 with either an hour versus 5 seconds.
does that mean
Bill,
that
this makes me think like do I need to know what the probability is any given day prior to expiration? Do I
Not
need
at
to know
all.
those probabilities as
Not
an
at
option
all.
trader?
I don't. I mean, I'm not even going to bother looking them up. I know roughly where they are, and I know where they're moving. That's all I need to know. I know
I don't
I
think
know
we
how
need
the
to know
position's
exact,
going to
right?
unfold. No.
Yeah.
In
the
fact,
idea
even if your
is to
platform tells it to
understand-
you to 4 decimal places or 6, it's meaningless.
Yeah.
It's not that type of a probability that
Didn't we have somebody in Q&A the other day that it was a little side conversation going on about how to make the decimal places go out like 8?
Oh yeah, you're right. They did.
Oh no.
Yeah.
Oh boy.
Ridiculous.
But the idea is that as time passes, the probabilities change, and options are not like stock. They have a limited life, where stock has a unlimited life.
There's a
Things are
time
going to
clock on
change.
them.
The probabilities are changing,
Correct.
and even thus the return on risk will change.
Yep. So we can see that here we've kept the spread the same, but what did we do? We shrunk time. So you can think of it in options terms. This was an in the money option, not very far in the money. But as time started to go towards 0, or as we approached expiration, your confidence of the team winning went up, and therefore the deltas went up. So if you can always just think about, in a certain situation, think of football, would I have more confidence that my team is going to win or less? And that's what you want to work towards. And then you're going to do exactly the same thing in the options market.
Here's a quick application, just a little sidebar here, just 10 seconds. Quick application. Look, suppose you have a stock replacement option and you were running with 80, 85 deltas, and now you're kind of pushing towards expiration. It's going up 90, 95.
Mm-hmm.
What's going on? The extrinsic value is going down. The strike is remaining the same. However, the deltas are going up. You can actually roll that option back to an 85 or a 90 delta. Yeah. And you can have less money in intrinsic value working with which, ultimately at the end of the day, you're going to have less dollars on the table. So that might be good for you in the event of some adverse action. And that could be a good hedge, right?
And what's that 85 delta going to do, Stu, as you continue to go towards expiration?
Well, it's going to do the same thing.
It's going to do the same thing. You're still going to be at 100 deltas, right?
To me, that's a huge advantage.
It's a massive advantage.
To have those limited funds of intrinsic value on the table.
Absolutely.
While gaining something that's resembling like stock.
Absolutely.
Who doesn't? Let's you're trying to assimilate.
Correct. So now that we have this little model to go through in our head, now let's start putting it to action with some options. And before we do, as always, please be sure to check us out, marketrebellion.com/get started. Wonderful tools on there, all for free to help you with your options trading. So let's look at an interesting graph that all of our traders know too well.
Hold on.
Now, this is a little different. It looks a little bit like a risk curve, but along the horizontal down here we have is time. It's not stock prices like we normally do. And on the vertical, we have deltas.
But time is going out. It's not unlike the theta curve where the time is.
Exactly. Time is actually, so we have, I don't have 0 on here, but this is 20 days. And then out here would be 330 days to expiration. Like basically a year out. So notice if we have
passing from right to left. Time is getting, the option is getting nearer to expiration as you go from right to left.
Correct. So we've got on top, we have an in the money option. So let's say the stock is at 100 and maybe this is the 95 call. It's 5 points in the money. With only 20 days to expiration, it might have a 92 delta.
Yeah.
But if you go and you say, well, let me look at the 60-day option. Why is it getting, maybe 78? Why did it drop, Stu?
Well, it's the other side of what we were just talking about, Bill. I mean, the farther out you go, the less delta it's going to have, the more extrinsic value you're going to have. You're going to have to push further in the money to get the higher delta, yada, yada, yada.
It's an in the money option. So again, go back to your football team. Your football team is winning. It's an in the money option, but there's more time on the clock. You have less confidence. If you have
More
less
time
confidence,
for it to fall out of the money.
then right. So you know that the deltas have to drop. And now we're seeing how it would drop in an actual pricing model way out to here. But look what happens for the out of the money for exactly the same reasons that we just saw. If you have an out, maybe this is the 105 call with the stock at 100, with 20 days to expiration, you might have a 10 delta. But if we say, I don't know if I want to buy that 20-day option, that's a long shot. That horse is in last place. Let me go out to 90 days. Whoa, look what happened to my deltas. Now we're like 35 deltas. Why did my deltas go up there, Scotty?
More time. There's more time for the probabilities to reverse course.
For your horse to catch up or your team to catch up. Do you see the model? We're starting to work on it and saying, yes, I have an out of the money option. If it had 20 days to expiration, I'm not real confident. If I have 90 days, I have more. It doesn't mean I've got great confidence, but I have more than with 20. If I have more, I must have higher deltas.
And not to bring up a tangent, but look how that curve around 45 days starts to change. 50, 45 days, 30 days. It's
pays to go out in time.
Those deltas start to change right in that sweet spot there.
If you're going to, it's a great observation. If you're going to play out of the money options, this is the professional trader's secret. Go out in time. Get those deltas up there. It's already still going to be a cheap, not counting volatility, but in terms of dollars, relatively speaking, because it's out of the money. But you might as well get some high deltas out of it. Now, if you look, higher. Now, we've got right here is a 50 delta, and we can see that if we have very little time on the clock, what happens with my in the money? I've got high deltas. I'm more confident that that option will expire in the money. This is like my football team being ahead by 20 points in the last 20 seconds here. I'm super confident it's going to be a winner. I've got roughly 100% confidence. It's probably going to be 100 delta. But if my team is losing with only 20 days to go, or 20 seconds to go, the option is, let's say 20 days, I have less confidence out here. And so it's going to be a very low delta. But look what happens over here. We flip. So over here, if I have an in the money option and I go and I say, well, let me buy the one that's, let's say 360 days out, it's going to have lower deltas. There's more of a chance for it to fall out of the money. And here, what's going to happen? I have more confidence because, yes, it's behind, but I also have more time for that to become in the money. It reminds me of the Stephen Wright joke. He said the sooner you fall behind, the more time you have to catch up. It's kind of true here. What you're saying is, all right, yes, my horse is in last place or my team is losing, but look at all the time I'm able to put on the clock here.
I can't wait till we do next week about the volatility.
Oh, yeah.
It's the very same discussion.
It's exactly the same discussion. What we're going to find out next week is why, though. Why are time and volatility really two different ways of looking at the same thing? So a little side note here. I know a lot of times people say that the deltas get pushed to 50. They get pushed towards 50. Very important. The out of the monies will go, you can see this black line is very close to 50, but this one is going to bottom out at around 60. And that's not from cost of carry. There are reasons for that. I'm not going to go into it. I just want to briefly mention it. So if anybody says, hey, wait, this graph was drawn wrong because that black line on top should be symmetrical. The shape should be symmetrical, but it's not going to be as close to 50. You will start pushing towards 50. I'm going to put another footnote in here, Stu, because I know a lot of people say all of these options go towards 50. That's true in most cases in the real world. If we push this time to expiration way out, and I mean ridiculously way out, and or push volatility up, let's say into the high hundreds or 1,000 or 2,000%, what happens? We're going to actually hit delta 1. So that's just a little footnote. Don't think that these push to 50 and stay there. It's just in most cases in the real world, you're going to be kind of moving towards this 50 mark. Okay, so now let's take a look at a 30-day option, $100 strike. Black curve is at expiration. Red curve is today. So here's a good question. Why is the curve either a straight line, delta 1, or a straight line 0 at expiration. Because we know it's either in the money, we know it with 100% confidence in case it's delta 1, we're on this part of the line, or we know with 100% confidence that we're on this part of the line. That's why those are straight.
So here's a little shout out to one of our people, Bill. Lynn, this is for you.
Hey, Lynn.
Ask yourself, why does the red line move towards
the
black line?
Yep.
See, that's what you want to focus on. What's happening in the real world that's causing the current line to move towards an expiration line?
Yep. So we're going to see that once we have the current curve, the delta is the angle of that line. Now, this angle right here is delta 1. So we can see this is a little less, and we might see that that's a delta 50. It's an at-the-money option because there's roughly a 50-50 shot for it to be in the money. But let's say the stock is way down here at 85. Look at that red line. It's virtually flat. So let's call it close enough to 0.
It's out of the money.
It's out of the money. Well, relatively out of the money because there's 30 days to go. And with 30 days to go, with the stock at 85, you're 15 points out of the money. Market saying, this game is over. What about up here?
And listen, that's what the market is saying.
Oh, now, yeah, it doesn't mean this can't be in the money.
Now, people say to me, should I dump this option? That depends on, the money, really. That's what it comes down to. Look, if it's a nickel or a penny or 5 pennies or a dime or, it's a lottery ticket. Yeah, keep it, I think. Well, why give it away? I've seen fortunes made with that kind of nonsense. And if you lose, so you lose the whatever's left in it, no biggie. But just understand what it is. It really is the lottery ticket at that point. So why give it away for nothing?
Right. Now up here, we can see that red line is virtually flat with the black, which means it's the same or pretty close, which means it's delta 1. Why?
Acting like stock.
It's in the money. Our team is ahead, and we're far enough in the head, even though there's still some time on the clock. We've got a pretty good lead. We're 15 points in the money. So the market says, you know what? This team is a winner. This option is in the money. That's going to be delta 1. But watch what happens if we increase time. We're looking at the 30-day option. We pull up our broker's platform. We look at the 180-day option. It's going to be more expensive. It's going to sit lower in the graph. But look at the current curve. Something interesting happens. These are real curves, by the way, from a pricing model. Look at that. They just touch right here because that is still delta 50 no matter how much time is on the clock. It's always roughly a 50% chance. But look down here. Now, when I had the stock at 85, that red line was virtually flat, but look at the blue line.
Yeah, this is what we were talking about before.
It's
There's
not
more
flat.
time. There's more time for it to
There's
go in.
more time.
So have a higher delta.
Now, do you have super high confidence in it? No.
No.
But you get maybe, let's say, 20% chance of being in the money,
Not
which is
the point. The point is it's
up. Point is exactly. Could it be 25? Could it? Of course. And depending on volatility, it could be lots of things.
Yeah.
We want to see that you get the direction correct.
Mm-hmm.
Now, what about up here? Let's go back to a stock price of 115. We had a delta of basically 100 with that red line, but the blue line's a little flatter up here. You see how the blue line relative to the red isn't quite as curved? There's a reason for that, for what we're talking about. That's why it's doing it. So my deltas are lower. They're still high, but they're not as high as they will be for the 30-day.
Yeah. Again, same thing. Just watch, rinse, repeat here. There's more time for it to fall out of the money.
Well, exactly.
Yep. Another point you could make in this graph is that the further out options have a less aggressive slope or arrival of profit and loss. This is a P&L curve, so the arrival at profits come more gradually. The arrival to losses come more gradually as well. You hold an option down to the 12th hour, your outcome's going to be more binary. Your speed at which you arrive at a gain or loss is more accelerated, sharper.
And that's all great information to know if you're trading, let's say, unusual options activity, or you're doing stock replacement. Those are vastly different strategies, and they require different tools.
It's not a right or wrong. There's an aggressive and a less aggressive.
They're just tools, correct. Yep. So that's the thing. We find that a lot of people have really good ideas about how to approach a market or a certain event that's happening, but they don't know which tool to pick. and why. And so hopefully this will give you a model to work with. Okay, so let's look at some examples here to kind of close things out. Let's start with at the money. Stu, we've got a stock at $100 call with 30 days to expiration. And what do you suppose is the delta here?
50.
Going to be close to a 50. Now, again, is it going to be 51 or 52? Might even be 55 or more if you put in high interest rates. It doesn't matter. It's somewhere around a half. That's the model to work with. Now let's just give it 10 days to expiration. What do you think now, Scotty?
Same. Virtually the same.
It's still because it's still an at the money option. We just saw that on the two graphs where they're always roughly going to be 50% at the money. All right, so that's a good starting point. So now I've got that in my head. Now let's take a look at some out of the monies. Stock is at 100. The 105 call with 30 days to expiration. So what are we going to put in our head here, guys? My team is losing.
It's an out of the money call.
It's an out of the money call. What do I want to see? Is the delta going to be higher or lower than at the money? So think about how much, do I have more confidence or less confidence?
Out of the money options are less likely, you should have less.
You have less confidence.
Yeah.
So it's not going to be a 50 delta. Give me a number.
40.
Might be 40, might be 35, could be 20, depends on volatility. I don't care. It's more, did you get the direction right? He went down in deltas, and that will always be true. Let's try the 110 call. Now we're going to go even further out of the money. We're going to keep the time the same. Is the delta higher or lower than the 105 call that we just saw here for Scotty, Stu?
Delta higher or lower than the 105 as, I'm sorry, I lost track here. What's the 110 call? It's going to be lower, dude.
It's going to be even lower because your horse is even further out of the money. He's even further behind.
Yeah.
So you have less confidence and therefore, you have lower deltas. All right, now let's get something really tricky. Let's use this 110 call, which so far has the lowest of the deltas, but let's give it 720 days to expiration. What happens now?
I'm saying, I think it'll be
Higher than the previous.
It's certainly more than yeah, exactly.
Yeah.
You see, now you might say, okay, it's way out of the money, but you have to think it's relative out of the money. Yeah, it's 10 points out of the money, but there's 2 years to go.
You just added another lap to the horse track. You gave him another go around.
You're just going, okay, yes, it's still 10 points out of the money, but look at the time we have. All right, that's again the way that you want to think about it. That's how people like myself and Stu and Scotty, when people say, what's happening to these deltas, we can figure this out. And I can tell you pretty close what those deltas will be.
And look, you could say to yourself, do I want more deltas or do I want less time or do I want more time? What's it going to give you? If you're looking for more deltas at a particular strike, that you're going to have to go further out in time.
That's another good use.
And it can just help you to strategize how to put together your strategy.
Right. I'm looking on my broker's
whether or not to roll. I mean, when your delta decreases, there's a strong case for rolling to a different strike or even rolling out in time.
Great point.
Which will also affect your deltas for this very reason.
Yeah, that's an excellent point. I get that a lot too. Yep. So it didn't quite work out or it worked out, grandly. Like, what do I do now? When do I roll? Well, what are your deltas looking like? Where did you come from?
Yep.
And do you still have confidence in the stock? Maybe they went against you. Your at the money call is now out of the money, but you're still very bullish at a lower level on the stock. Well, what are you going to do? You're going to keep the same option? Maybe you should roll it down to the lower strike and pick up the higher delta.
Pick up the higher deltas.
Same thing with the other way, right? Maybe it's now in the money. Well, maybe you want to roll it, like Scotty say. Maybe you want to roll it to a lower delta.
Sweep some of those deltas off the table. Correct.
Absolutely. Yep. Great point.
So as I mentioned, this is another tactic for this. You're looking at this option. You say, no, it's only got a 30 delta. It's an out of the money. This 110 call. What do I need to do on my broker's platform? Do I need to look at closer dated options? No, I know immediately if I want more deltas, I've got to look out in time. I know it's not going to be looking at the next month. You'll start to figure out roughly where you need to look. So these are really good models to have in your head. All right, let's close with the in the monies. Stock is at 195 call with 30 days to expiration. So what's the model? All right, my team is winning. Remember, it's always about the probability of expiring with intrinsic value.
Is this Belichick or is this Holmes? I mean,
well, right now, what we do know is that it's in the money. If time were 0, we know it's in the money. All right, so we can start there. We know that's a fact. We know that's 100 delta if time were 0. But the question is, will this delta be higher or lower than at the money?
And
at the money we saw.
Everybody should be able to answer these questions, right? It's an in the money option.
Your team is ahead. Are you happier? Are you more confident about your team winning if they're ahead or if it's dead even? Well, obviously, you've got more confidence. You should say the deltas are higher. Now, whether it's 58 deltas or 65 deltas depends on a lot of things. For this presentation, it doesn't matter. We just want to see that you get the direction correct. Let's do a 95 call with 60 days. So the same strike, but we're going to double the time. Delta now, what's happening? Higher or lower than the 30-day?
Lower.
Well, for that one, the delta, when you extend the time out, the delta on this option is actually going to come down a little bit.
It's actually going to come down. My team is ahead. What I think about this, if my team is ahead, I'd love to see the time go to 0.
Yeah, sure.
I'd love to be able to snap my fingers and put 0 time on that clock because now I'm 100% sure that team's going to win.
And now just go the other way.
Now you're on the opposite side of the trade. You're going in the other direction.
And now it's the opposite effect.
Exactly right. Now let's do it.
I'm not a big soccer fan, but in soccer, don't they add time to the clock at some point?
Yep, exactly. So that could also be a very good model for saying what's going to happen to your confidence, in which case it would be bad for the winning team. $95 call with 720 days to expiration. Delta higher or lower than the 30-day? This is an in-the-money option. Our team is ahead. We just talked about it. If time is 0, I'd be super happy. I'd be jumping for joy. But now what you've done is you've put hours and hours on the clock.
2 years, man. Anything can happen.
Yeah, your deltas, now your confidence like, it's basically a 50-50 shot. And you know what? Your deltas probably aren't going to be that far off of 50.
Yeah.
Because it's just in the money a little bit, but you've got so much time.
And even that term, a little bit, that's relative.
It's exactly right. It's all relative. Well. And we're going to find out next week it's relative to volatility.
Yeah.
So back to our Chalk Talk question here, guys, and everybody out there on YouTube. So here we go. Stocks at 103. $100 call is $4. Your delta is 70. What delta is the call moving towards as time passes?
Yeah, who got it right? All right, everybody should get it right.
So what's the model here? Is this a winning team or a losing team?
Winning.
We're above 50. 50-50 is the start of the game. So we are definitely winning. I can also see it here. Stock is 3 points, or the option's 3 points in the money.
Mm-hmm.
So I would love to see time go to 0. If time is 0, I'm 100% confident that that's going to be in the money.
Right.
So
and the other side of that statement is there's no time left for it not to be in the money.
Right. Now, also, so we know that delta's moving towards 1. Now, just to clarify, that's why I did this with a question. Don't confuse this with being profitable. Where is this call option moving towards, Stu? What prices?
3.
It's moving towards 3 because there's going to be $3 of intrinsic value. If you paid 4, you say, hey, those guys were wrong. My delta's 1 and I lost. Remember, it's not about profit. It's about, is it in the money? That's what the model's trying to figure out. Is the option in the money or no? And if you can keep that very, very simple model in your mind, you will start to have a much better understanding of how your options are going to behave because you'll know how your deltas are going to move.
For sure. And you can start thinking about things like, well, the stock went in the direction that I wanted it to go, but I didn't make any money in my options. What happened and how can I fix it?
And how exactly?
You know, a great exercise that I tell folks to do, Bill, is look at the 4 strikes on a 30-day option, 4 strikes on a 60-day option.
I love it.
And observe the deltas. Look at the deltas and look how the
look
variance.
At 2 in the money, 2 in and 2 out, or even 2 in, 2 out, and an at the money, and just go across in time. It's a fabulous exercise.
Yeah, it really is.
But
really
then ask yourself, before you click on that expiration date to see what the answer is, ask yourself, what's it going to do? Well, I know
just
my
use,
in the monies
just use
are
the
going
platform to answer to test yourself.
to test yourself. Don't just
Yeah.
click on it. Ask
great.
yourself what's the answer, and then see if you're right.
I love it.
I think that's a great idea. And of course, some of the many things that we like to teach here is to show people not just what the answer is, but why.
And by the way, Bill, as you were talking, I actually went to dictionary.com and I looked up moneyness. It says no results found.
I was going to be surprised if you said that it's there's a definition in there. Yeah. I think that is strictly an option trader's term.
Yeah.
So anyway, we hope that helps. Again, it might be a little confusing the first time you see it. Go back and watch it. But trust me, it's every bit as easy as just saying, am I more confident that my team is going to win or less confident? And it can be that they've either gotten a bigger lead, in which case confidence is up, delta's up. That's the same thing as the option going deeper in the money. Or what about time? Are they in the lead with less and less time? My confidence is going up. If we're going in the other direction, confidence is going down. And once you get that, you'll be set.
And as you're thinking about that, everyone, think about what that really means. You know, like the 80 delta, what's that mean? Well, 80 cents per $1 move.
Yep.
90 cents per $1 move, 50 cents per $1 move, an equivalent stock position. You know, try and apply it to the real world. Mm-hmm. Does it meet your goal, what you're trying to do? Yep. As time passes or as stock moves, and next week we'll talk about implied volatility. Is it still fitting your goal, and do I need to make an adjustment?
Absolutely true. So as Stu said, we will definitely show you now how volatility fits into the picture. If you work with this, you're already ahead of the game, because you're going to see it's basically time in disguise, and that's going to make things a lot easier. So work with it, and that will give you some wonderful tools to make you better traders. Scotty, thanks for being here, and we hope you can join us next week when we do part 2 and we look at where is your position moving towards, so that next time somebody asks you, we can do what? No crickets. Okay, so thanks everybody for joining us, and we will see you next Thursday.
All right. Thanks, Bill. Everyone have a good week.
Yeah. You too.